Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The Federal Reserve's monetary pivot is live and active right now, and it's creating significant trading opportunities across every major asset class. After three consecutive 25 basis point rate cuts throughout 2025, including critical moves in October and December, markets are pricing in two additional cuts through 2026. According to Principal's first quarter 2026 global market perspectives, this would push the federal funds rate just below the neutral range midpoint. That positioning changes everything for sector rotation, duration trades, and crypto volatility. Let's start with where we stand today, March 1st, 2026. The Fed has pivoted dovish, but economic fundamentals remain robust. Corporate profitability is holding strong across sectors. Consumer spending patterns show resilience. And most critically, artificial intelligence capital expenditure is projected to hit $1.3 trillion over the next 5 years. That AI spending wave is the structural catalyst supporting tech megacaps even as traditional value sectors struggle under compressed margins. The sector rotation dynamics are playing out exactly as lower rate environments dictate. Growth assets are pulling capital aggressively. Technology companies positioned in AI infrastructure and software are seeing renewed institutional interest. When you have $1.3 trillion in AI capex projected forward, that creates fundamental support for names tied to data centers, chip manufacturing, cloud services, and enterprise AI deployment. The rate cuts amplify this by lowering the discount rate on future earnings, making high-growth companies more attractive on a present value basis. Real estate investment trusts are another clear winner here. According to the research, REITs are experiencing enhanced attractiveness as lower interest rates directly reduce funding costs for property acquisitions, while dividend yields become significantly more competitive relative to compressed bond yields. For income-focused portfolios rotating out of traditional fixed income, REITs offer both yield pickup and potential capital appreciation as borrowing costs decline. This is a direct function of Fed policy reshaping the opportunity cost equation. Now the losers in this rotation. Traditional banking and financial services are facing structural headwinds. Lower net interest margins are pressuring earnings for regional and money center banks. When the yield curve flattens or inverts and absolute rate levels compress, the core lending business model suffers. Value-oriented financial stocks are underperforming as capital flows toward growth. If you're positioned in traditional banks, the thesis needs recalibration unless you're playing a specific turnaround or M&A catalyst. Bond markets are where the duration trade is delivering outsized returns. Longer-dated Treasury securities carry significant price sensitivity to yield changes. As the Fed continues easing and market participants price in additional cuts, Treasury yields compress and bond prices appreciate. The magnitude of this move accelerates in longer duration instruments. According to BlackRock's analysis on portfolio implications of Fed rate cuts, this duration positioning represents one of the most direct ways to capitalize on the easing cycle without taking equity beta risk. Corporate credit is tightening as well. Investment grade and high yield spreads are compressing as default risks decline and refinancing conditions improve with lower benchmark rates. Companies that were facing 2026 and 2027 maturities at elevated rates now have refinancing windows at materially better terms. That's reducing credit risk across the board and making corporate bonds more attractive relative to risk-adjusted returns. Now let's talk crypto because the dynamics here are fascinating and contradictory. Bitcoin is currently trading around $66,000. That represents a 29.3% decline from the all-time high reached in October. So we're in a drawdown despite dovish Fed policy that theoretically supports risk assets. According to CNBC reporting, this type of volatility and drawdown is actually historically normal for Bitcoin cycles. But the immediate macro complexity is creating short-term pressure. Here's where it gets interesting. Clear Street executives, as reported by CoinMarketCap, are calling for Fed rate cuts in 2026 to drive retail crypto participation back into the market. The thesis is straightforward. Lower yields on traditional safe assets like money market funds and short-term treasuries reduce the opportunity cost of holding non-yielding assets like Bitcoin, improve liquidity conditions from Fed, easing support risk asset pricing broadly, and reduce borrowing costs enable increased speculative positioning through leverage. However, current macro complexity is tempering any immediate rally. Year-end tax loss selling effects carried into early 2026. Regulatory uncertainty continues affecting institutional adoption timelines, and liquidity conditions vary significantly across different digital assets. The CoinMarketCap analysis highlights that institutional and retail dynamics are diverging right now. Institutions remain cautious on near-term entry despite dovish policy, while retail hasn't fully re-engaged yet due to the drawdown psychology from the October highs. The critical question for crypto traders is whether $66,000 represents a technical support level that holds as retail begins rotating back in, or if we see further compression toward lower support zones before Fed cuts catalyze a sustained move higher. The monetary backdrop is supportive, but positioning and sentiment need to shift before that translates to price action. From a risk management perspective, several factors require continuous monitoring despite the supportive Fed stance. Inflation resurgence remains a tail risk. If core PCE or headline CPI prints start accelerating again, the Fed's easing trajectory gets called into question immediately. That would trigger repricing across duration trades, growth equities, and risk assets broadly. Labor market data is equally critical. Wage growth patterns and employment tightness affect the Fed's policy flexibility. If labor markets remain too tight, inflation risks persist and limit further cuts. Global economic coordination is another variable. If international central banks diverge significantly from Fed policy, currency dynamics and capital flows create volatility. The research from Principal's Global Perspectives emphasizes diversified fiscal stimulus measures supporting international growth. But policy divergence introduces cross-border risk. For active traders, the current environment sets up several actionable strategies. Duration positioning in treasuries remains attractive if you believe the Fed delivers the anticipated 2 additional cuts. Technology growth stocks with AI exposure offer structural upsides supported by capital expenditure trends. REITs provide income and rate-sensitive appreciation potential. And crypto represents a higher risk, higher volatility play on liquidity conditions improving and retail re-engagement. Critical data points to watch include monthly inflation readings, particularly core PCE, employment reports focusing on wage growth and participation rates, consumer spending indicators and confidence surveys, and corporate earnings reports that reveal margin sustainability under current economic conditions. Technical market levels are equally important. Treasury yield breakpoints signal when duration trades accelerate. Equity sector rotation thresholds indicate when capital flows shift decisively between growth and value. And cryptocurrency support and resistance levels provide entry and exit signals for tactical positions. The convergence of supportive monetary policy, $1.3 trillion in AI-driven capital investment, and evolving market dynamics creates a high opportunity, high complexity environment. According to the research from TIAA's first quarter 2026 chart book and Principal's Market Perspectives, success requires filtering noise and focusing on high-signal economic data, technical levels, and Fed communication patterns. The bottom line for traders right now, the Fed's March 2026 pivot is live, rates are coming down, and that's reshaping every asset class. Growth is outperforming value. Duration trades are working, REITs are gaining, banks are struggling, and crypto is volatile but positioned for potential retail re-entry as opportunity costs decline. Watch inflation data, labor market prints, and Fed speak closely because any deviation from the expected easing path reprices risk immediately. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.